You think your biggest trading problem is taking bad trades. It usually isn't. Most traders spend years believing that losses come from entering too early, reading charts incorrectly, or choosing the wrong strategy. They keep searching for a cleaner setup, a better indicator, a sharper entry signal. They tell themselves that one more adjustment will remove uncertainty from the market. But uncertainty was never the problem. The strange thing is this: many traders don't lose because they enter too much. They lose because they hesitate at the exact moment they should act. And here is the question you need to ask yourself when you stare at a setup and your finger hovers over the button. What exactly are you afraid of? Because most people answer that question too quickly. They say, "I'm afraid of losing money." And no, not entirely. If losing money were the real issue, then every stop loss would feel unbearable. Yet many traders accept small losses with little emotion. The discomfort comes from somewhere else, something quieter. You see a setup you recognize. The structure is familiar. You have seen it before. The conditions match your rules. The risk is defined, and suddenly your mind becomes very active. What if this one fails? What if I enter and it immediately reverses? What if I'm missing something? Then you wait. You want another candle, another confirmation, another sign, and while you wait, price begins moving exactly as expected. Now something interesting happens. You feel relief and frustration at the same time. Relief because you avoided risk. Frustration because you missed opportunity. Have you ever noticed that? Have you ever watched price run away without you and felt more pain than if you had simply taken a small loss? Most traders have. Now, why does that happen? Because fear of entering a trade is rarely fear of losing money. It is often fear of being wrong. And people underestimate the difference. Money can be replaced. A small loss can be recovered. But being wrong touches something personal. It challenges judgment. It challenges identity. You begin feeling that every trade says something about you. A winning trade says you are smart. A losing trade says you are careless. A winning streak says you understand the market. A losing streak says perhaps you never understood it at all. So without realizing it, you stop treating trades as business decisions. You start treating them as personal verdicts. Now think carefully. How can you enter freely when every trade feels like a judgment of your intelligence? You can't, because suddenly the trade becomes heavy. The market is no longer a place of probability. It becomes a courtroom, and you become both the defendant and the judge. That is where hesitation begins. The market presents an opportunity. Your rules say enter, but another voice appears. Be certain first. Make sure. Here is the problem nobody tells beginners. Certainty is expensive, and eventually it becomes impossible, because by the time certainty arrives, price has already moved. The move is halfway finished. The clean entry is gone. Risk has increased. Then the same trader who hesitated before suddenly enters late. Now ask yourself something. Have you ever skipped your planned entry, watched price move without you, then chased it out of frustration? That sequence destroys more accounts than people realize, because hesitation creates regret. Regret creates urgency. Urgency creates bad decisions, and bad decisions create losses. Do you see the chain? One emotion quietly creates another, cause and effect. Most traders focus only on the final mistake. They see the bad entry. They see the unnecessary loss. But they ignore where it began. It began 10 minutes earlier when fear stopped them from acting on their own plan. Now let me tell you something important. Fear itself is not evidence that something is wrong. Many traders make this mistake. They think confidence should come before action. They wait to feel ready. They wait to feel calm. They wait to feel certain. But confidence often comes after action, not before it. A surgeon can perform thousands of procedures and still feel pressure before beginning. An experienced pilot still respects the possibility of error. Pressure does not disappear because skill appears. So why should trading be different? The goal is not to eliminate fear. The goal is to understand it. Because fear speaks different languages. Sometimes fear says, "This setup violates your rules." Listen carefully when it says that. But sometimes fear says, "What if you lose?" That voice requires examination. Because if the setup fits your process and risk is controlled, then fear may simply be asking for guarantees that do not exist, and the market offers no guarantees. Now let us make this practical. The next time you hesitate before entering, do not immediately look at the chart. Look at yourself. Ask a simple question. What exactly am I waiting for? Not generally, specifically. What information am I waiting for? If you cannot answer clearly, something important is happening. Because often there is no missing information. There is only emotional discomfort, and emotional discomfort disguises itself as analysis. The trader tells himself he is being disciplined, but in reality he is delaying uncertainty. Those are not always the same thing. Watch your behavior carefully. Do you repeatedly seek one more confirmation? Do you move from one time frame to another searching for agreement? Do you suddenly become interested in news after your setup already appeared? Do you begin asking opinions from other traders? Why? What changed? Your plan was already there. Your setup was already there. So what happened? Fear happened. And fear is clever. It rarely announces itself openly. It dresses itself as logic. It says, I'm just being careful. Sometimes that is true. Many times it is not. Now here is an observation worth remembering. Traders who fear entering often believe more information will save them. But information has an interesting effect. Past a certain point, more information creates more conflict. More conflict creates more hesitation. More hesitation creates less execution. Less execution creates less experience. And without experience, confidence never develops. You see the trap. You cannot build trust in your process if you never allow yourself to participate in it. Because a trading plan sitting on paper means very little. A plan becomes real only after repeated execution, trade after trade, decision after decision, not because every trade wins, but because every trade teaches. And there comes a moment where a trader begins noticing something unexpected. He enters despite discomfort. He takes the loss. And strangely, nothing collapses. Then he enters again, and again. Then slowly he realizes the thing he feared was never really the loss itself. It was the story attached to the loss, the meaning attached to being wrong. And once that begins to separate in his mind, he starts seeing the market differently. Because now he understands that his job was never to predict every move. His job was to recognize conditions, manage risk, and act when the evidence appears. And that changes the entire experience. Because when you stop asking, will this trade win? And begin asking, does this trade meet my conditions? Something starts becoming quieter inside you. Not silent, just quieter. And that is where many traders discover something they were not expecting. The fear never completely disappears, but it changes shape. The cost of waiting for certainty is rarely visible in the beginning. That is why most traders never notice it. They believe patience and hesitation are the same thing. They tell themselves they are being careful. They think they are protecting capital. But there is a line between discipline and delay, and many traders cross it without realizing it. You see a setup forming on your chart. Price reaches an area you planned for. The structure looks familiar. Conditions begin matching the rules you created when the market was closed and emotions were quiet. Everything seems to be lining up. Then something changes. A question enters your mind. What if this one fails? At first, it sounds reasonable. After all, risk exists in every trade. Nobody wants to step into unnecessary losses. So you wait for another candle, then another. You tell yourself you need more confirmation. Now ask yourself something. How much confirmation is enough? Most traders cannot answer that question clearly. And that is where the problem begins. Because if your standards keep changing while the trade is happening, then you are no longer following a process. You are negotiating with fear. The market has a way of exposing this behavior. While you wait, price begins moving. Slowly at first, then faster. Suddenly the move you planned starts unfolding without you. Now your emotions become divided. Part of you feels relieved because you avoided risk. Another part feels frustration because you missed opportunity. That frustration matters more than people think. Because once the market moves without you, your thinking changes. The calm decision maker disappears. The observer becomes a pursuer. You begin saying things like, maybe I can still catch it. Now you are entering under different conditions. Earlier, you had structure. You had a plan. Now you have urgency, and urgency changes behavior. You stop thinking about risk properly. You stop asking whether the trade still makes sense. Your attention moves towards something else. You begin focusing on what you already lost by not entering. That is dangerous because people behave differently when trying to recover something they believe escaped them. Have you noticed how traders often enter after a large move instead of before it? They hesitate at the planned entry and become aggressive after the opportunity already stretches away. The strange part is that they think they are avoiding risk, but they are often increasing it, because certainty always becomes more expensive. Early in the move, uncertainty is high but risk can be controlled. Later in the move, certainty appears stronger because price already proved itself, but now entries become worse, stop distances become larger, and reward potential begins shrinking. That is the trade nobody notices. People think they are exchanging uncertainty for safety. Many times they are exchanging opportunity for comfort. The market never rewards comfort consistently. It rewards preparation and execution. This does not mean entering every trade without thought. It does not mean acting recklessly. The answer is not blind action. The answer is understanding what you are actually waiting for. Because sometimes more information helps. Sometimes a setup is incomplete and patience protects you. But many times traders are not waiting for information. They are waiting for a feeling. They want to feel safe. They want to feel certain. They want the market to whisper that this trade cannot fail. And the market never says those words. Losing a trade hurts. Every trader knows that feeling. You enter with an idea. The market moves against you, and your stop gets hit. Money leaves the account. Confidence takes a small hit, and for a moment you question your judgment. But there is another kind of pain traders rarely talk about. Missing a trade. And sometimes that pain stays longer than an actual loss. Think about it. Have you ever watched a perfect setup appear on your chart and hesitated? You saw it forming. You recognized the pattern. You understood the conditions. You even felt that familiar feeling that said, "This looks right." But you waited. Maybe you wanted another candle. Maybe you wanted stronger confirmation. Maybe you wanted the market to remove uncertainty before you acted. Then price moved exactly where you expected. You sat there watching it happen. That feeling is different from taking a loss. A loss has an ending. The trade closes. The result becomes real. The event is finished. But a missed trade behaves differently. A missed trade keeps talking to you. You start replaying the chart in your mind. I saw it. I knew it. I should have taken it. Notice what happens next. You are no longer reacting to money. You are reacting to regret, and regret has a strange effect on decision-making. A loss usually teaches caution. Regret often creates urgency. That urgency begins changing behavior in small ways first. You start staring at the chart more intensely. You begin searching for another opportunity immediately. Your mind quietly says, "Don't miss the next one." Now ask yourself something. When people become afraid of missing something, do they become more selective or less selective? Usually less. Because now they are not entering to follow a process. They are entering to escape a feeling. The emotional pain of watching opportunity leave without you creates pressure. The next trade starts carrying extra weight. You tell yourself it is just another setup, but it is not. You are bringing emotional baggage from the previous decision. This is why traders often make a strange sequence of mistakes. They hesitate on a good trade. They miss it. They feel frustration. Then they chase a worse trade. Then they lose. Then they sit there wondering why their behavior suddenly changed. The behavior did not suddenly change. It changed much earlier. It changed at the moment hesitation created regret. People think bad trades begin at entry. Many bad trades begin before entry even exists. Now here is something worth thinking about. Why does missing a trade hurt so much? Because when you take a loss, uncertainty disappears. You accepted the risk, participated in the event, and received an answer. But when you miss a trade, the mind creates stories. You imagine the profits that could have happened. You imagine the perfect execution that never existed. You imagine how good you would feel right now if you had simply acted. And imagination has no limits. A losing trade gives you reality. A missed trade gives you possibilities. Possibilities can become dangerous because people naturally make them bigger than they really were. The mind starts turning one missed opportunity into something extraordinary. Suddenly it was not just a trade anymore. It becomes the trade. The trade that would have changed the week. The trade that would have recovered losses. The trade that would have proven you were right. But markets keep moving. Opportunities continue appearing. What hurts is not always the missed setup itself. Sometimes what hurts is the realization that fear made the decision instead of you. Because deep down, traders can accept losses more easily than they accept hesitation they cannot explain. Money lost through execution feels like part of the game. Opportunity lost through fear feels like something else entirely. Fear almost never introduces itself honestly in trading. That is what makes it difficult to recognize. If fear walked directly into your mind and said, "I'm stopping you from acting," most traders would catch it immediately. But it does not work that way. Fear is subtle. It rarely says, "I'm afraid." Instead, it says things that sound intelligent. "I'm just being careful. I need a little more confirmation. I'm trying to improve my entry. I'm making sure everything lines up." Now ask yourself something. Have you ever said those words and felt completely convinced by them? Most traders have, and sometimes those reasons are valid. Careful thinking matters. Confirmation matters. Patience matters. The problem begins when fear starts borrowing the language of discipline. Because then it becomes difficult to tell the difference. You see a setup developing on your chart. It matches your plan. Conditions are appearing exactly where you expected them. The trade is approaching the moment where a decision needs to be made. Then your mind suddenly becomes extremely active. You switch time frames. You check another indicator. You look for news. You search for opinions. You begin collecting more information. At first glance, that behavior looks responsible. It appears logical. More information should create better decisions, right? Not always, because there is an important question hiding underneath. What exactly changed? Your setup was already there. Your rules were already there. The market conditions did not suddenly transform. So why did your need for extra information suddenly appear at the moment action became necessary? Many times the answer is simple. Fear entered the room, but fear does not want to be recognized, so it puts on a different face. It disguises itself as analysis. That is why traders sometimes become trapped in endless preparation. They continue studying, continue adjusting, continue searching for stronger confirmation because they believe certainty exists somewhere just outside their reach. They think one more detail will remove doubt. One more indicator. One more pattern. One more signal. But there is something strange about that search. The closer people move towards certainty, the more uncertain they often become, because every new piece of information creates another decision. One indicator agrees. Another disagrees. One time frame looks strong. Another looks weak. One opinion supports the trade. Another warns against it. Now confusion starts replacing clarity. Have you noticed how some traders become less decisive the more information they gather? There is a reason for that. Information helps until a certain point. After that point, too much information begins creating conflict, and conflict slows action. The mind starts searching for perfect agreement between everything on the screen. But markets rarely give perfect agreement. That means hesitation begins growing. Then something interesting happens. Price starts moving without you. Immediately your mind changes direction. Earlier you were cautious. Now you feel pressure. Earlier, you needed more confirmation. Now you suddenly feel like you need to catch up. Do you see how quickly emotions change? A few minutes ago, you believed you were making a logical decision. Now frustration appears. That frustration reveals something important. If your hesitation was purely analytical, you would remain calm after missing the trade. But many traders do not stay calm. They become irritated. They become restless. Because deep down they realize they were not solving a problem. They were avoiding discomfort. Fear often does that. It convinces you that avoiding emotional discomfort is the same thing as improving decision quality. But they are different things. Good analysis asks questions that create clarity. Fear asks questions that delay action. Good analysis works toward a decision. Fear works toward temporary relief. That relief feels useful in the moment, because avoiding uncertainty always feels safer than stepping into it. But trading does not reward temporary emotional comfort. The market does not care whether you feel ready. The market does not pause while you negotiate with your emotions. And the dangerous part is that traders usually do not realize fear was controlling them until after the opportunity disappears. Only then do they look back and notice something uncomfortable. Nothing was actually missing. No critical information suddenly appeared later. No hidden signal arrived. No magical confirmation emerged. Most traders think bad entries begin at the moment they click the button. They look at a losing trade and immediately focus on the execution. They blame timing. They blame the market. They blame the setup. They tell themselves they entered too high, too low, too early, or too late. But sometimes the real mistake happened long before the trade was ever placed. It began with hesitation. This is where many people misunderstand the process. They think hesitation is harmless because technically nothing happened. No money was lost. No trade was taken. But trading behavior does not begin with execution. It begins with decision-making. And hesitation changes decisions in ways people rarely notice. Imagine a setup appears on your chart. You have seen it before. You recognize the structure. Your plan says conditions are valid. Risk is defined. Everything points toward action. Then a small thought enters your mind. What if this fails? Now that question by itself is not dangerous. Every trader experiences it. The problem starts when you begin negotiating with it. You wait for another candle, then another. You tell yourself you are simply being cautious. Meanwhile, the market starts moving. At first, the move is small. Then it becomes larger. Now you are watching price go exactly where you expected while sitting on the sidelines. Something changes inside you. Earlier, you were calm. Now you feel pressure. Earlier, you were evaluating. Now you are reacting. Have you ever noticed how quickly emotions shift once opportunity starts moving away from you? Because missing a trade creates a very specific feeling. Regret. And regret rarely stays quiet. The mind immediately starts calculating what could have happened. I knew this setup. I saw it. I should already be in this trade. That thought creates urgency. Now the trade starts becoming emotionally heavier than it was a few minutes ago. Earlier, it was just an opportunity. Now it feels like something you already lost, and people behave differently when they think something belongs to them. They chase. This is where the connection between hesitation and bad entries becomes clear. The trader who refused to enter earlier suddenly becomes willing to enter later. Think about that carefully. The same person who demanded extra confirmation at the planned entry suddenly abandons caution after price moves away. Why? Because emotions changed the purpose of the trade. Earlier, the goal was to execute a plan. Now the goal is to remove frustration. That difference matters. Because emotional goals create emotional decisions. You stop thinking clearly about reward and risk. You stop asking whether the trade still offers favorable conditions. You stop following the process that protected you in the first place. Now your attention becomes fixed on one thing, catching the move, and chasing usually creates problems. Risk becomes larger. Stop placement becomes more difficult. Potential reward begins shrinking. The trade becomes less attractive at the exact moment emotions become stronger. Do you see the trap? Fear creates hesitation. Hesitation creates regret. Regret creates urgency. Urgency creates poor execution. Then poor execution creates losses. Most traders only notice the final step. They see the bad trade and think that was the beginning. But the chain started much earlier. Bad entries are often symptoms rather than causes. The market simply reveals what already happened inside the mind. That is why two traders can see the same chart and behave completely differently. One follows the plan, accepts uncertainty, and enters according to rules. The other hesitates, waits for comfort, then reacts emotionally when the opportunity begins moving. The chart was identical. The setup was identical. The difference was not the market. The difference was what happened between observation and action. Because once hesitation quietly enters the process, it rarely stays in one place. There is a difference between trading a setup and trading your emotions. but many traders do not notice when they cross from one into the other. The change is quiet. There is no warning sign on the screen. No message appears saying your decisions are no longer coming from logic. The chart still looks the same. The candles still move. The market still behaves the way it always has. But something inside the trader changes. You build a trading plan for a reason. You create rules when your mind is calm, because calm thinking usually produces better decisions. You define what conditions matter. You decide where risk belongs. You identify what must happen before you enter. Simple, clear, structured. Then the market opens. Now emotions enter the room, and suddenly things become less clear. You see a setup developing. Price approaches an area you wanted. The structure begins forming exactly where your plan expected it. Then a thought appears. What if this one is different? That question seems harmless. It sounds intelligent. But now watch what happens next. You begin looking harder. You search for reasons not to act. You stare at every candle as if it contains hidden information. You start feeling tension. Now ask yourself something. Did the setup change, or did your emotional state change? Because those are very different things. A trader focused on the setup asks practical questions. Does this meet my conditions? Is risk acceptable? Does this fit my process? The answers are usually measurable. Yes or no, present or absent. But emotions ask different questions. What if I lose? What if I regret this? What if I look foolish? Notice something important. The first set of questions looks outward toward the market. The second set looks inward toward personal discomfort. That shift matters, because once your attention moves from market conditions toward emotional protection, you slowly stop trading the setup itself. You begin trading how you feel, and feelings change quickly. One candle can create confidence. Another candle can create fear. A small pullback suddenly creates doubt. A strong move creates excitement. A sharp reversal creates panic. If emotions become your guide, then your decisions constantly move with them. Have you ever noticed how traders sometimes become very confident after several winning trades? They start entering aggressively. They stop waiting for proper conditions. Risk suddenly becomes larger. Why? Because they are not following the setup anymore. They are following a feeling. Now look at the opposite situation. A trader experiences several losses. The next setup appears and suddenly hesitation grows. The conditions are identical to previous trades. Nothing meaningful changed, but fear now exists in the background. The trader waits. Questions increase. Doubt increases. Again, the setup remains unchanged. Only emotions change. This is why emotional trading becomes dangerous. Emotions are temporary. The market does not care about temporary feelings. A setup either matches your process, or it does not. The market does not ask whether you feel confident today. It does not ask whether your previous trade was painful. It does not adjust itself according to your emotional state. Yet many traders unknowingly allow emotions to become decision makers, and emotions rarely remain consistent. One day excitement pushes them into trades too early. Another day fear keeps them out of good opportunities. Then frustration appears after missed moves. Then impatience follows. Then revenge enters. Now the trader begins feeling as if the market itself has become unpredictable. But many times the market did not suddenly become confusing. The trader became inconsistent, because once emotions quietly take control, the process starts changing from trade to trade. Rules become flexible. Standards begin moving. Decisions become personal. And eventually the trader stops asking the most important question. Not, will I win? Not, how much money can I make? But something much simpler. Am I acting because the setup exists? Or because my emotions need something from this trade? The need to be right creates problems in trading, because it sounds like a strength at first. Most people grow up believing being right is valuable. In school, right answers bring rewards. In business, being correct builds reputation. In everyday life, people respect accuracy and confidence. So naturally, traders bring the same thinking into the market. They believe good traders are the ones who predict correctly most of the time. They believe success comes from always knowing what happens next. On the surface, that sounds reasonable.